exposing the secret sauce in business-to-business marketing. The Tagline Podcast is where real stories meet proven strategies. Let's elevate your business. Real strategies, real stories, real results. In the business-to-business industry, you're not selling to businesses. It's human to human. We break down what works, what doesn't, and how you can truly stand out. Transparency, credibility, growth. Get a behind-the-scenes look at what drives success in business-to-business marketing. Get ready for the next Tagline Podcast powered by the Ably Group.
Welcome back to the Tagline Podcast. My name is Justin Starbird, and today's exciting. I get to welcome, a new friend in a new space for us, Mark Perlmutter from Planet Positive Investing. Mark, great to have you on today.
Great to be here, and I'm honored. Thanks, Justin.
It's kind of cool. We got to meet at a Devon Thorpe super green event a couple of weeks ago, I guess maybe a month ago now, helping to drive the idea of clicks to sustainability, or for sustainability companies that are looking to crowdfund. It was a very complicated topic and difficult to but
Yeah.
the best part
Not
about
to mention how many speakers there were over 3 days. It was amazing.
Yeah, it was an incredible event. And Devin does a wonderful job of pulling everybody together and creating some real value there. It was really interesting to be put on the spot the way we were, though.
Well, it was easy for me. You guys carried the load, and I learned a lot listening to you, and so I'm glad to be here today.
Yeah. Mark, you've had an incredible career and done so much with to help and create impact for companies that are opening themselves up to community rounds and to raise from their crowd. Talk a little bit about your career and what has led you to today.
Thanks. Sure. So I'm retired now. My primary career was first real estate, but my primary career was really the stock market as a stockbroker, a licensed stockbroker. But my activity was raising capital for projects. I never traded stocks. And as an early business person, I thought, okay, let's see, stock trading. In order for one person to make money, somebody else has to lose. A bad trade, you're on the wrong side of a trade. And it just didn't feel like I was making a contribution. So I always liked to raise money for new projects that would build something. And then in 5 years or 7 years, it would sell and there would be a profit at the other end, hopefully, for the early investors, usually through a limited partnership. Sometimes it was large public limited partnerships in the case of oil and gas, but it was real estate. We did a lot of cable TVs. We got rolled up into the AT&T acquisition. We also did licenses for local cellular networks, which then got rolled up as well. I'm talking 80s and 90s.
We won't date you. It's fine.
Yeah. Windmills, solar energy. Yeah, I'm a good old, I'm an older guy. And it was exciting. One thing I did, which was really exciting, was jojoba farms, jojoba research and development, because it replaces whale oil from the commercial process. Oils at high temperature burn and melt, and the commercial application of whale oil is that it holds 600 degrees Fahrenheit. And so this wax that grows in a plant called jojoba in the desert actually matches whale oil. So that's the use of whale oil. It's also, that's the use of jojoba oil. It's also in a high-end cosmetics all over Europe and, other high fashion industries. So I've had a wonderful career. I've tried to, raise capital and be supportive, be a part of the cog in making companies do well that are going to do good. And that sort of led me to sitting in a desk talking to you today.
Yeah, it's so interesting to hear about how you kind of came up. When did you first get introduced to crowdfunding?
Oh, you're gonna love this. Of course, the law passed in 12. In 13, I put on a large summit with 12,000 people. It was a free summit. I wanted to teach the marketplace. It was really for professionals. And we had 75 speakers, including the Congress people who passed the laws. We had some speakers from other countries where they had been experiencing crowdfunding or versions of it. Like Australia had a program, and England was way ahead of us in that British Isles. So that was my actual involvement in crowdfunding. But you're going to think this is really crazy. In 1995, I opened my first website called Direct IPO to do small IPOs online. And the laws were so fragmented, you had to register in each state. So it was a burden that was just too heavy to lift for a small offering. So we never got any success in that, traction in that. But of course, 15 years later, we got the game playing. And of course, the history of the crowdfunding, everyone, and probably listeners to this broadcast will know, later after the 12, it took 4 years before it was enacted. So Obama signed it, but in 2016, we didn't actually get the codification, meaning here are the rules, you can now do it. So there were all these crowdfunding portals up and running in 12, waiting, and they were doing mostly privates, which means accredited only. So they weren't truly the crowd, they were a very segment of the crowd. And then in 16, we got the law codified, people started doing it. The maximum was $1 million per year. And then a few years later, I think it was 22, we got $5 million. So it went from 1 million max to 5 million per year. And that significantly expanded the appetite for companies to use this format, as I'm sure you know. Yeah. So it's very exciting to see this pathway. So that's been my little bit of history in the crowdfunding.
And so candidly, I and Tag and the company, our team is newer to the space. And so I feel like in some levels, we don't have any bad habits yet, helping our clients or trying to be overly reliant on one tool or something, but I've heard from folks that have been in this space a little bit longer that it was like the desert from 2012 to 2016, and then when there was like a little oasis from 2016 to 21, but it was really set up to fail because, to your point, you were only able to raise up to $1 million. So really that didn't move the needle for a lot of companies. And then in 21, end of 21 into 22, when it opened to 5 million, it's been not the wild west, but certainly it's been a lot more appealing to companies. Talk a little bit about, or share your opinions on, what that difference from 2016 to 21 and then the opening to 5 million has really done for companies.
God, what a great question, Justin. That's exactly right. It was quite sparse. Okay, so let's think about marketplace. Companies that have traction, that are raising money for growth, they don't want to go into a small space. They want to try to get a bigger number. And because you have to spend so much setup time and money to get a crowdfunding going, 1 million didn't attract those growth companies that were getting traction. And so it was what we call adverse deal selection. The first couple of years, most of the deals that used crowdfunding didn't have traction, didn't have an alternative. To say it honestly, probably less quality deals used crowdfunding in the beginning. And we made the case to Congress, not me only, lots of other people represented this to Congress. And so they finally expanded the law. Actually, the SEC expanded the law under Congress's permission. So here's what I've seen happen. We've seen increased quality deals. We've seen something called the community round, where part of a series round, so a more mature company, not just a raw startup, a more mature company will be doing, let's say, a $10 million Series B, and they'll carve out $1 million for their crowdfund. And that'll be at the same terms and the same treatment as the negotiated price by the venture capital professionals. So the crowdfund people get the benefit of investing with somebody who's sitting on the board, who's going to force an exit. We don't want to be in a private company forever. We want an exit. Yeah. And when you have someone on the board who has an interest in an exit, that really represents your position. And the second thing that happens is you get pricing. You get better pricing negotiation when you have someone who's standing there writing a check for $8 million, but here's the terms. So that really helped to set better deals in the market. And I think we saw valuations come back down, because the valuation is in the crowdfunding world, is really set by the issuer. There's no third party in between the investor and the company saying, well, that's too high for the investor, or that's too high for the company. This is a fair middle range. That's what a broker dealer or an investment bank generally does. When crowdfunding is being done with no third party, just a platform allowing anyone to post any price for any deal, the general public doesn't really understand to look for valuation. And the question of valuation is this: if I'm buying in at a valuation of 20 million, this company has to sell at least 21 million for me to get any profit. And to get a 5-to-1 return or 10-to-1 return, which is what I'm looking for in risky early stage companies, it's got to sell at 100 million. Can this company sell at 100 million? Is there a market for these kinds of companies? So that thought process is beyond most retail investors.
Yeah. Well,
so that's where we are today.
Now, going back again, I'm sorry for the history lesson. It's interesting to get your opinion. And I do want to jump into, what you're working on now, but do you see that 21, 22 range also was about the same time that the venture capital money, seemed to have dried up, or that the terms for the founders were positive? Now it feels as though the people that, to your point, writing the $8 million checks can really put it to them, to the founders, and basically write their own deal, and that's hurting the founders. So now there seems to be an influx of opportunities for crowdfunding, and that is possibly a way for some of these other venture capitalists to de-risk their deals, because now they're seeing traction, they're seeing folks in the community, and that maybe does give the founders a little bit more leverage. Is that fair? Or
I think that's a good observation, Justin. I think you're correct. My company is called Planet Positive Investing right now, but we just rebranded last December. And so for the first 4 years, from 22 to 26, we were Vegan Investing Club. So we were primarily focused on the vegan space, which would include foods, clothing, makeup, shoes, like that, mostly retail products. And my mission was to accelerate the vegan economy for the better of the world and help people that wouldn't know how to do it build their own little portfolio of 20 or 30 small investments, where they have a little bit of money in many companies and hopefully get one return to pay for all the losses that are going to happen, because that's startup world. And so, I wasn't really dealing with venture capitalists at that time, my deals, and that I was representing, the deals I was helping. I did see a couple that had a series round, which a community round, which I thought was great. And I really emphasized that for my members to take advantage of that and put a little money in that round. I do think that we saw kind of a frothy market in 2020, 21, and 22 in the vegan space. So products were probably that, were high valuations, and probably products that really don't have a venture capital profile. They have more of a business growth profile. So they're not going to give a return of 10 to 20 to 1. They're probably double their money or something in 5 years. So it would be a good loan, but it probably wouldn't be a good equity risk. We saw a lot of deals like that come into the space in the vegan sector that we were focused on. I think since then it's become quite sober. There's been a lot of failures of the overhyped vegan meat and alternative vegan food, and the what they call fermented food or grown food, whatever, they make fake beef and fake fish and stuff like that. So anyway, I think markets always have cycles, and over time there's a trend, and you try to follow the trend. So I do think today, to your point, we have a more sober market for entrepreneurs to get a better deal, because venture capitalists now see the wisdom of having $500,000 or $1 million invested in retail investors in that same round they're in, so that there's this message happening out there in the public conversation about that company. Now, it might be a B2B company, but it's still great to have people writing and talking about what a great idea it is and how they've used it, or they want their company to use it. They're going to introduce someone in their corporation to check it out. So I think having a raving crowd would be great, or at least a positive crowd where they have an investment, is becoming more accepted. And to your point, it's giving the crowd, the crowdfund issuers a little more strength in the negotiation with their venture investors when they are talking to them.
Yeah. One of your goals, and I love this, part of your mission is that you're working with your own community and followers on the Planet Positive Investing Club to educate them and give them opportunities that they might not have had previously. How do you go about, on one hand, educating them, and then on the other hand, doing the research and finding the companies that you are suggesting to them?
Great question. Startup, judging a startup's future is almost impossible. I mean, you might as well take a crystal ball. There's no third-party reported evidence. We don't have financials. They don't have a long enough history to see. Now, some of the best markers are previous deals that team has done and any exits they've done. So that's what we look for. Do they have traction right now? Do they have a couple million in rev? Or at least have they raised a couple million? So it's really hard to predict. You obviously want to be picking a company that has a big market to grow into if they are successful, if they become the market leader or one of the market leaders. So I really think I try to teach my members, and they join for free. We don't charge it. We're not a financial advisor. So basically, I tell them what I do. I tell them what I look for and let them do whatever they want. And I just send it out in an email, and then they do whatever they want. I don't track it. I don't ask them what they did. We do see the page go up after we make an announcement of a company to our members. So we have some idea about how much money came in that week from our announcement to our members, but we don't track any individuals. But what we teach, to your point, is diversification. It's like if you fall in love with one early stage deal, the odds are against you. Unless you have insider information, you're never going to pick the right winner. So it's very important to diversify. And obviously, it should be companies you like because you're probably going to be looking at it for the next 5 years. Remember, a startup, you're talking about 5 to 10 years hold time period. You're going to be married to this company for a while. So you better like the sector it's in that you want to follow.
You better like watching those updates.
Better like watching those updates. And diversification would mean not only maybe cross industry, but also age of company, and traction. Of course, a company that has more going for it is going to be priced a little better. Maybe they're in their third seed round or third pre-round before venture money, and they might price it, higher than their first round. And if you're taking more risk, you get a lower price in the first round. So diversification over age of company and category of industry would be my advice. Not that I'm a financial advisor. I'm not. That's what I do. I've invested in about 80 small companies. Some of them are in Europe because I lived in Peru for many years. So I was able to invest in the European marketplace through my checking account. But I wasn't able to invest through my US bank account. So, most of those are still in, they're still trying to grow and get an exit. Some of them have failed, which is what I expected. You expect that with early startups. And so I tell people, expect failures. Don't be surprised. Don't be depressed. It's not
right.
to be, not to be avoided. What you're looking to do is see which ones are the winners. And a professional investor, a venture capital investor, they typically will invest in a 10 or 20 deals in a round, in their venture round that they raise. And then they nurture those deals. They're on the board, and they're helping those deals, making introductions, trying to guide those deals. And the ones that fall away, that's a loss, but they've saved money to do the next round of growth for the ones that make it to on their first projected milestones. So that's what I would say to my people. I'll give you an example. May I give a specific example? Is that okay?
Yeah, absolutely.
So there's a company that we did an offering. We did help their offering. They were doing a crowdfunding. We helped them by announcing to our members they were a vegan pizza company, vegan frozen pizza company. And they are called Blackbird Foods, based in Brooklyn. They had this thing where they fermented their dough overnight. And somehow it rose more. I don't know. It was their special magic sauce, And people loved it. Brooklyn pizza is a brand, And they were in 3,000 doors around the country selling their frozen pizza. And they also have a chicken nuggets from seitan, which is a wheat-based thing. So it's, again, vegan. And they were doing quite well. And so they were doing third crowdfunding. And we announced them to our members. And our members loved it because it's a product they could see in the store. So they could actually go check it out and say, yeah, it's good, I'm going to invest. Second thing is pride of ownership. They get to show their wife or their girlfriend or their husband, hey, I invested in that company. Buy that next time you go to Whole Foods. So it's kind of like a participation event. You get to brag or talk about companies you invested in at Thanksgiving or Christmas dinner. And then this company went on to do another round, and we helped them. We announced a second time to our members, and we told our members, look, this is a slightly higher valuation. The reason is they've grown. They used that money that you raised last year if you invested, that we announced. They accomplished the milestone they said the money was for, and now they're back for their next round at a higher price, which is what you want to see because the company is growing and succeeding. This is exactly the stair step that a company goes on in the path to an exit. And you're on the ride because you got on in stair one, maybe you get on in stair two, you invested in their first crowdfund, you invested in their third crowdfund. And since then, they've been acquired. So it's a success story. So last time I read, there were over 4,000 stores nationwide.
Yeah, I've heard of them. We did not work on that deal. I'm familiar with it though. And it was really interesting. There's another one that's coming out. I think it's like Zero Carb Life or something, and similar. Anyway, I really actually you make a point I wanted to touch on that I didn't expect to, and that was thinking about the crowdfunding and the investments that you're participating in at step 1, step 2, step 10, wherever they are on their journey, and then they do get acquired. Talk about or share how you actually do get that return on investment at that stage, because often, non-retail investors or I'm sorry, retail investors are thinking about buying the Magnificent Seven or some sort of stock, and then now it jumps up in price, and so they call their broker, and then they sell it, and now they've made more money. But that's not necessarily the case specific to some of these deals, because they have so many unique SPVs out there for them to use. So I guess in broad strokes, talk about how you share with your club how they get their money back.
So really important question, because as I mentioned earlier, we're not investing to be owners in a private company for our lifetime, pass it on to our kids. No. We want to see an exit in a window that's reasonable. Now, in the startup community, and if you look at professionals, their funds usually run 10 years. They're investing for 5 years. And during the second 5 years, they're either nurturing, and then they're starting to divest. So they can return money to their limited partnership investors. Because remember, they're professional money investors are managers of money of somebody else, pension funds, family offices, whatever it is. So think the same way. Think when you invest, you're going to be holding for 3 to 4 to 5 years, and then you're going to be either selling, or somebody's going to be, if there's a secondary market, which there may be, and they're starting to be in these crowd funds, but more likely it's going to be acquired. And in that acquisition, you usually be offered cash for your shares, because the acquirer wants to have 100% control and do what they want to do. And so they usually buy out the early investors. And another example is called renewables. They just finished their offering, so I don't mind talking about it. We helped them by announcing them to our members. Some of our members took advantage of it. This is an interesting company. Although it says renewables, it sounds like food. It's actually electric tractors, small tractors that have attachments that do all kinds of things. They plant, they weed, they water, they do all kinds. And why would you need an electric tractor? Because tractors usually run on diesel. Well, if you want to be standing behind a diesel mower all day, breathing diesel, that's why you want electric. Or if you're a woman farmer, it's a little harder unless you're a big, hefty woman, 6-8 hours a day in the field pushing these small tractors. These are tractors that sometimes you walk behind and you have a motor that runs it. But so it's kind of like a giant lawn mower setup. And so this company comes out with this electric tractor that has clean air, and it's remote control. So you're walking behind it with a remote control. and it does weeding, and it will do seeding, and it'll do other features, rowing and so forth. I don't know I'm not a farmer, but I read about it. And so it made so much sense. And the market, small farmers around the world, come on, big. And people want to get away from diesel. Well, if you're a farmer that uses diesel tractors, they'll tell you they want to get away from diesel because you're breathing it all day. It's no good. So that was a great example. Now, he had a previous exit. He had started a company to do the same thing. And like 4 years ago, did a crowdfund. And in 6 months got acquired. So the crowdfunders got bought out in 6 months at 170% of the price they paid 6 months earlier. And I say that's a win.
Absolutely.
It doesn't fall in the category of one of the losses you're expecting. Yeah. It wasn't the 5 to 10 times you want, but it's so quick, you can reinvest that. So I thought that was a big win. He had a great track record. That company went on years later to fail. And so he started up the same idea again, but innovated and made it better. He's got AI in there now and remote control, which he didn't have in the first round.
Sure.
So there's, that's the exit strategy for most companies. I want to tell you to watch out for something that's common in the Reg A space, which Reg A is like the granddaddy of Reg CF. I know you don't want to talk about that, but the difference is that a lot of companies start Reg CF, and if they don't get picked up by venture capital, they go on to do a Reg A. A Reg A allows them to raise $75 million per year.
The Reg A plus, the Reg A plus,
all from the public. So it's like a Reg CF, which is 5 million limit per year. It's like a Reg CF on steroids. Okay. Now, many of those companies then go on to list their stock. And the problem is they've gotten so high at valuation that they can't maintain that in the public market where there are analysts reporting on the performance of that company, which now has all the numbers are out there, all the financially verified expenses, growth, revenue, profit and loss, that's all there. And it's very difficult to hold the price that they go public at to give the early crowdfunders an exit opportunity at a higher multiple. And so many of them fall way below that inflated, superheated listing price. And they can do what's called a public listing without an offering, or they can do an IPO, initial public offering and a listing. So there are two ways for a private company to get into the public traded market. And unfortunately, a lot of companies have used Reg CF, they got high valuations, Reg A plus, higher valuations, and then they're in the stratosphere. And they can't publicly trade at a lower price because all their stockholders will be pissed off. So they have to trade. They start out trading day at a high price, and then they can't hold it because the market doesn't support it. So that's one thing to watch out for in the public exit.
Yeah, of course. And coming back to what you do with the Planet Positive Investing Club, and you've done such a good job of sharing this insight with your members. Do you ever find any, I don't want to say conflicts of interest, but where you're looking for a specific type of deal because of the history of how you've invested previously with those returns and what they're doing? How do you juggle that?
Just yesterday we had an internal discussion. That happens all the time. Not exactly a conflict of interest, but we have a mandate that we establish, self-mandate. Now, I funded this company. I don't have any outside investors that I have to follow their guidance, but I started as a vegan company, and vegan has a very specific definition to people who think of themselves as vegans. It means no animal products at all. And what's really interesting is tires use animal products. Concrete used to use animal products. Today it doesn't, but ancient history, the Romans used animal eggshells in the concrete. There are some other products that use animal products in manufacture, of course, leather, clothes or car seats or something like that. So where do you draw the line? are we going to not promote an electric car because the tires use stearic acid, which comes from animals? And they bought these tires from a third-party supplier to put on their car to sell to the customer. And are we going to not promote EV, clean air, because of an ingredient 3 or 4 generations backwards in the development of this end product? That's a big question for us, right? Now, that's part of the reason we changed our brand. We're not turning our back on the vegan mission. That's still a big part of our mission. But we're also going to include things like EV cars, which might have one small ingredient in there that came from animals. Well, that's the real world we live in. Let's affect the real world. Let's not go off in the woods and be a commune. You know, that was why I became a stockbroker. I've been a vegan for 54 years, but I didn't run off in the woods like most of the vegans I knew back then. I went into the belly of the beast and I tried to change the world from within. So that's partly the mission. We've expanded our brand to include health tech, climate solutions, energy solutions, and plant-based solutions. And we hope that will bring many, many more people that would never have considered joining a vegan investing club, but now they'll join a planet positive investing club. And while they're a member of us, they'll hear from me and they'll learn a little bit about how plant-based helps the environment, how plant-based helps general public health in many cases. And so they might be more interested in investing in a vegan startup when they learn that from us. But if they never do, that's fine too. So we can serve the plant-based economy while we're also serving the climate solution and the energy solution and the health tech solution economies too. So that's our umbrella now. It's a bigger umbrella, a bigger playing field. And obviously we want to reach more and more members because that's how we make a bigger effect.
Oh yeah, absolutely. What has that, so being a marketer, of course, I'm always very curious about how did that rebrand go? Here you are looking at the calendar, you're about 50 days into it or so. How has it been received? What has the feedback been so far?
Look, I'm what you call a seasoned vegan. New vegans are a little more enthusiastic and maybe extreme. So we did get a pushback from a couple of members saying, are you selling out? Are you doing what everybody else does, going corporate on us? I said, no, we're trying to make a bigger difference on our planet and affect more people's lives. So the positive input from our members was overwhelmingly positive. We had already announced some solar energy and some windmills and one river cleanup, where they make products from the plastic they collect in rivers. Now, that's not a vegan product, but it certainly is aligned with vegan values. So we announced a bamboo company that makes houses out of bamboo to save, cut down trees. We announced a windmill company that has a windmill that doesn't spin fast enough the birds don't fly into it and get hurt. So there was some alignment with these non-vegan products. And we just decided to make that change. We got overwhelming support, as I mentioned, from we have over 29,000 people joined our list since we started in 22. And I honor everybody's position. I'm just doing what I'm doing. I'm doing the best I can.
Yeah, no, I appreciate that. And that is really neat to hear. Rebrands can go in any number of directions. And so it's always interesting to, especially out of the...
You have any advice for us? Because you see at the bottom of my emails, it says, Mark Perlmutter, founder, Planet Positive Investing. And then in parentheses, it says, formerly Vegan Investing Club. Do you recommend that phrasing, or do you recommend a different explanation?
I think in the interim, that's really helpful, especially as folks on in your club may have missed some of that stuff because over the holidays and start of the year,
exactly,
all sorts of things get lost. I'd say after the first quarter, you could probably, this is my opinion, you could probably remove that and go all in on it. I think those are elements that are, so interesting. I think doing a newsletter later on as you go, maybe a one-off instead of it just being some of the deals that you share, but also like, hey, look at what our growth has been. Look at our
history. Yeah.
Yeah. And then I would also add a referral code. and create some swag for your club members so that if they refer one person, they get, something, just a little shout out or something, or maybe even less. And then, at 10, they get a t-shirt, or 30, at 100, they get a mug. I don't know, you come up with, there's a couple of different ways to refer. And then that adds folks to your list that, are aligned with your values, especially where you've grown your umbrella a little bit. So I think,
Wow. Now I see why you're having such a successful agency. That's a great idea. Thank you for that free advice. And I was getting coaching today. That's great.
that's all right. Well, hey, I feel like you've shared a lot with me and our audience. The least I can do is give you a couple of things to do for your business, so.
Yeah, I think if you don't mind, I'd like to suggest it's not on your, I don't think it's on your outline you gave me, but I'd like to talk about the future of crowdfunding, if you will, if you don't mind. And
yeah, actually, that was my next question.
oh, okay.
I had, with all this, we're way off of our initial line in terms of.
That's what I do.
Yeah,
Sorry. That's what
no, all good. But also what I do, I try to make sure that the questions that follow up aren't so, specific. I want this to be a real discussion. So having and hearing your thoughts, about the history of it, I'd love to also hear about what you see for the rest of 26 and then the next, immediate future.
Well, it's easy. If you look at the long arc, it's really easy. Securities laws primarily came into play after the big crash in 29. And it was because of certain practices and excesses which accelerated that crash. And so some of the laws we have today are from that period. They're still there. Everything's changing. Of
Like
course,
1933 and 1934 is when those laws were passed.
Yeah,
Right?
exactly. And it was a knee-jerk reaction. A lot of it was overreaction. It happens, So what do we have today? Where are we today? Well, we did have a lot of penny stock abuses that they had to cramp down on back in 05. And even in the 90s, they were even shutting down a little bit. And then they closed the door on those. And then that left a void. What's the void? Well, the public is getting more educated with the internet about stocks and about early startups. Before that, startups it was a cult. It was often little incubators at MIT and Silicon Valley and, Pittsburgh. There was pockets around universities usually, or it was done internally, skunkworks inside, Intel or something like that, or Oracle. So when the public becomes aware, that makes sense. That's the timing when they would want to start and when it would be appropriate for them to start investing. That's what sort of happened with the internet. Since the internet, there's information flow, there's awareness, there's you're learning things that are happening in Silicon Valley. You're in Tennessee, you're in Texas, and you can follow. You can get on the podcast of a couple of bloggers, and you feel like you're down the street from Apple. So that's where we are when the crowdfunding laws are written and passed in the Congress. And so people had used the internet to make investments on their own through online broker dealers, Schwab and E-Trade and so forth. And now they're following startups, which is early stage investing. And so it's a pretty exciting time if you're interested in playing in that game as a hobby or as a profession. And so now what's the future? Where are we right now? Where are we for future? Well, the retail investor, small people like us, get to invest sometimes alongside venture capitals who are full-time. They have resources to help the company that they make the investment in, and we're shirt tailing in the same round, same price, same terms. And when they exit, we exit. That's a great opportunity. So I urge all of my members to look for those crowd funds that have what's called this community round, where most of the round is being done by professional money, and then the same price and terms are offered to the public. I see more of that. I think that's going to really accelerate for the point you made, Justin, which is that it helps the company to have proof of market and also having raving fans out there. It can help you convince a VC that, yeah, we deserve this valuation and there's a market for us. So that really helps the entrepreneur and the deals move forward. And I think it helps VCs make an intelligent decision because they have evidence rather than their own opinion. So I see the future community rounds going. I think there will be specialized portals. Right now we see, there's a big three. There's 3 or 4 big portals doing all the deals. I think there's going to be specialized portals, not only in sector, meaning categories, because now you have a convergence of, let's say, on one portal, you might have 500,000 members of that portal who love automotive, energy, and battery technology deals. And so if you were a battery technology deal, you'd want to go to that portal. And so I think there'll be some specialization of portals. The second thing I think there'll be these stair steps where the portal will help you from your crowdfund 1, crowdfund 2, crowdfund 3, and then you'll graduate with that same company. They'll help you with the Reg A. And then maybe they'll help you with secondary trading. So there's an exit for the guys who invested in their first crowdfund 5 years earlier. Or they'll help you with listing or acquisition. So I think there'll be a maturing of the market, providing a package of services for the lifetime of the company, and of course, lifetime of the investor in that company, that early stage investor who got in and is exiting 10 years later. We would love to see professional patterns being followed.
Yeah.
And love to invest with a pattern.
Yep. I think that's great. So, all right, I'll get you out of here on this. What gets you up every day? It seems like you've got a pretty strong passion for not just life, but this space as well. What gets you up every day, and what is some really behind the scenes advice that you give to your club members or your VIPs?
Let's see, what gets me up every day. So making a difference in the world I'm part of while I'm still above ground. That's my goal for the rest of my life. And I'm 74, and I have another 46 in me. So I have a long plan.
Yeah, absolutely.
That's a whole nother story. I'll tell you about that. I visited a guru in the Himalaya in India, and that's where that comes from. I'll tell you later.
All right.
But I like to make a difference in the world, obviously a positive difference. I like to be part of a solution. I love to be around something that is a win, whether it be for the internal team that's making money, whether it's a successful company, or whether it's an environmental or a health or some other public domain that's being improved because of the products and services that this company is bringing forward. So I really like making a difference through business. That's my playing field. I chose that many, many years ago, and it's where I remain. I do like teaching what I learn, but I don't do it as a profession in any way. It's just I teach what I've learned about investing and startups and how to judge them, and I share that with my members. I do a lot of, I sometimes teach classes and I do a lot of public speaking about health and my chosen diet, my preferred diet. How do you know when someone's a vegan? Don't worry, they'll tell you, right?
That's right.
So that's me. I'm always telling people because I want to share what I believe is true and valuable. So that's what gets me up in the day. I do love people. I love being connected and interacting with people. So I'm a social being. I don't do well. I didn't do well in the pandemic. Woo! It was tough for me.
Well, I really appreciate you sharing all that you have about Planet Positive Investing and what really makes you go. I think this has been a really awesome episode and time with you. And I think there's a lot more, I don't know if I would say meat on the bone, but you're vegan. So there's more to harvest later, I think, right? That's what we want to do.
Yeah, there you go.
More
That's
out
great.
of it.
Nice, Justin. Yeah, I look forward to learning and seeing how your great agency does. I'm really impressed with what I've learned from you about your agency, and I look forward to great things for you.
Oh, I really appreciate that. I look forward to helping you grow your list as well, and hopefully there's some stuff that we can continue to do together down the road.
Let's have a conversation about that. I appreciate it.
Sounds good. On behalf of my guest today, Mark Perlmutter, the founder of Planet Positive Investing, you've been watching and listening to the latest episode of the Tagline Podcast. Until next time.